The majority of the stocks in the S&P last week were down, as we can see, lots of red right across the board, and that also extends to some growth stocks which we want to analyze today. In fact, we're going to see, do we buy the dip on these 6 high quality companies? We're going to run through each one as usual, looking at their historical performance. We're going to look at their earnings expectations over the next few quarters. And as always, we're going to run through some very key metrics, their free cash flows, ROIC, debt levels, and we're going to plug them into the valuation model, getting to our own intrinsic value. What is the margin of safety we see for each one, 10, 20, 30, 40%, and understand whether or not Wall Street themselves are bullish and the upside that they have forecasted over the next 12 months. Now, the first company is Hims & Hers Health, which took a bit of battering off the back of the Amazon news. They are down 26% just over the last 5 days. Over the last 12 months though, still phenomenal performance, up 151%, and if you've been a shareholder over the last 5 years, up around 95%. Now right now, this company is trading in the midpoint of the 52-week range after the pullback, and we can see Seeking Alpha give this a strong buy, Wall Street give this a buy, and Quant, although we do see a hold, 3.47, not far off the 3.5 for a buy, so you could argue they are on the fence. In terms of forward P, well right now, 35.66, S&P itself does trade between 25 to 26 in the current market. Now in terms of moving forwards, the expectations, we can see 3 of the next 4 quarters, Hims are anticipating 3 of them to be very strong growth in comparison to the year-on-year earnings per share. And we also note, out of the last 4, management have a 100% historical forecasting accuracy, which is always good to see. Although we do have to make you aware, over the next full year, they are expecting a small drop in the EPS, which in turn will increase that forward P to just under 40. Now, in terms of Hims & Hers, the actual metrics that support this company, free cash flow per share, as always, we focus on this as opposed to the earnings. This is susceptible to manipulation by management through accounting. Now, the good thing to note, yes, it was negative from 2018 to 2022, but in fact, it flipped to positive in 2023. A nice increase on the trailing 12-month and growth anticipated over the next 12. So hopefully it is moving away from the negative free cash flow and we can see some sharp growth to the free cash flow overall moving forwards. Sales growth, very, very good. Double digit every single year. In fact, 2019, triple digit. And even on the trailing 12-month, 57%, very attractive. Hopefully we won't see a sharp slowdown and these strong double digit increases can continue into the foreseeable future. In terms of numericals, well, we can see 30 million was what they reported in 2018. 2023, 870 million. So that is rapid growth that they have just seen in the last 6 years. And the ROIC, very interesting. What this tells us, given it is negative from 2018 to 2023, that they weren't able to report a bottom line profit. Although based on the trailing 12-month, 10% is noted. Remember, that is what we want to see at the bare minimum to give us faith management are able to effectively allocate their capital. So we do have hope for the full year accounts of 2024, they can report their first net income. That is also reinforced when we do look at the operating margin, negative although decreasing from 2018 to 2023 and 4% positive on the trailing 12-month. Very similar on the free cash flow margin. This does effectively mirror what we saw above on the free cash flow per share, but nice to see positive in 2023, even higher on the trailing 12-month. So it does look like they have had some trouble previously, and now we are starting to see a lot of good metrics. And that is one thing to consider with companies that do increase very rapidly in the share price. We see them turn around from previous negative metrics to positive, like we see ROIC, free cash flow per share, operating margin, something just to bear in mind. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. We have here the number of years it would take the company to pay off all of their debt net of cash on hand. And remember, this metric correlates to their balance sheet strength. 0 in 23, 0 on the trailing 12 months, 0 over the next 12 months, effectively telling us for Hims & Hers Health, it won't even take them 1 day to pay off all of their debt net of cash on hand. Very good balance sheet. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now typically we run through how we got to each one. We'll do it just for the first one today as we are going through 6 in total. We got $25 based on the DCF model, and as we can see here, we have the free cash flow year on year Average growth 93%, although it is skewed as it's gone from negative to positive. Now we have a growth rate moving forwards of 25%, as we can see low, medium and high. Based on the 25% with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see $25, indicating 31% upside if they do hit that into the future. Now remember, these numbers are subjective and you can always grab a copy of the model by clicking on the pinned comment below, running through your own numbers, whether it's for Hims and Hers Health or any others in your own portfolio or on your watch list. Now for full transparency, we'll just show you the others, so if you believe it should be more conservative, at 20%, $18, not far off the current trading price, downside of 5%, at the 30 higher percentage level point, we see here $34, upside of 80%. As we said though, we'll take the medium 25% rate through, and we always on this channel like to add a margin of safety, 10% at the bare minimum, and execute on that company if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode we'll buy at $22.38 and we keep going till it's near the current trading price. And what we can see in today's episode for Hims and Hers Health, you're getting between a 20 to 25% MOS. Some people will believe a little bit of a risky company, especially with the Amazon news, and maybe want a little bit more. So at the 30% point, buy around $17.41, at 35% around $16, and at the 14% around $15. As we said though, today's episode between 20 to 25, and Wall Street over the next 12 months, their price target not far off our intrinsic value. They have a $24 target, upside they note 26% over the next year. As always, give us your thoughts below. 20 to 25% MOS, 26% upside, buy, hold or sell. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, so a new copy coming tomorrow, where we discuss severely undervalued stocks as well as what's gone in the market over the last few days. So click below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. We run through lots of information as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. We then move on to Uber Technologies, which is down around 12% just over the last month. Over the last 12 months though, up around 36% in line with the S&P. Over the last 5 years, it is up 173%. Now trading in the midpoint of the 52-week range, we get a double buy rating from Seeking Alpha and Wall Street. We can see here Wall Street not far off the 4.5 strong buy rating, which is where Quant currently sit. In terms of forward P, sitting at 40.23, and when we take a look at the expectations moving forwards, a little bit mixed. Some quarters they're expecting growth, some they're expecting a decrease, but when we look back, they have essentially outperformed on 3 of the last 4, 75% track record. More recent quarter, very nice 79-cent beat, and ultimately over the next full year, they are expecting earnings per share to continue to increase, lowering the forward P to 32. Now, in terms of the metrics for Uber Technologies, it does follow a very similar trend to what we just saw, and we do in fact note it turned positive in 2022, very nice jump into 23 and on the trailing 12 month, and expected to continue that upward trajectory over the next 12. We also see very good in terms of sales growth, no surprises during COVID lockdown, down 14%. More recent year, 17% increase to their top line, and ultimately when we do zoom out, massive growth as well, just under 4 billion in 2016, 37.3 in 2023. Now we also have to let you know, in terms of shares outstanding, they have diluted your position as a shareholder over the last 10 years, increasing from 412 million to 2.15 billion in that latest quarter. As always, we do prefer it when companies do the opposite, doing share buybacks, essentially returning excess cash to shareholders' pockets. Again, very similar to Hims and Hers Health, where we saw negative ROIC, although good to report in 2023 and on a trailing 12 month, it is moving towards that 10% minimum target that we do have when we want to execute on companies. Operating margin, again, reinforcing negative margins. In fact, net loss 2023 and trailing 12 month increasing, but we would like to see this around the 16% at least over the next few years. and free cash flow margin ideally minimum 5%, which is what we get in 2023. Nice to note 15 on the trailing 12 month. Finally, net debt to EBITDA, the fact that we see 0.66 on a trailing 12 month looking very good. 0.5, so coming down. Management clearly looking to delever the balance sheet, one of their capital allocation priorities. So again, balance sheet, no worries, similar to what we just saw with the previous company. So in terms of valuation, we have $85, and we do note that is a little bit lower than Wall Street. Their price target, 92, indicating upside of 26%. And as we said, they weren't far off giving this company a strong buy, which is what we noted for Quant. So a 10% MOS makes this a buy at just under $77, and at 15% is pretty much around where the current company is. So Uber Technologies, 15% MOS, 26% upside. Do you believe this is a buy or a hold, or in fact, you believe this is one that you should look to sell? Let us know below. We then move on to the energy drink company Celsius Holdings, now trading at its 52-week low, down 25% over the last 12 months. Over the last 6 months, down 73%. Although if you've been a shareholder over the last year, it wouldn't look any better, down 50%. However, over the last 10 years, up 17,000%. And whilst you would be happy if you have been holding for a long time, you probably would be disappointed that it did fall dramatically from around $100 per share in May this year. In terms of the forward P, well, around 37, and whilst we have a double buy rating, we get a strong sell signal from Quant. So when we look at their earnings per share, well, they are expecting this to decrease over the subsequent quarters, and they did in fact miss 2 of the last 4, as well as their more recent one, giving them a 50% track record. Nonetheless, EPS is expected to grow to 97 cents in December 2025, lowering the forward P to 26.6. When we look at their metrics, well, again, these growth companies are following a similar trend. Lots of negative free cash flow, did turn positive in 2022. Nice increases up to the trailing 12 month, but we can see that is anticipated to drop over the next 12. In terms of sales growth, very, very good on a historical basis. In fact, the last 3 years triple digit, but we see that massive drop on the trailing 12 month at 19%. One of the reasons why, in fact, we have seen that share price start to come down. In terms of numerics though, no surprises given that growth percentage wise. In fact, they reported 10 million in 2014, 1.32 billion in 2023. Similar to the company we just saw, they are diluting your position as a shareholder over the long term, and something they have been doing in fact every single year without fail. ROIC, nice to report, 24% in 2023, 19% on a trailing 12 month, but it's very interesting the similar trends that we are seeing across these growth companies today, and that is once again reflected in the margins, negative up until 2023, although we do see that 6% in 2020, a small drop into the trailing 12 month at 17%, and the free cash flow looking very good over the last 2 years and the 11% trailing 12 month basis. Net debt to EBITDA, fantastic, especially over the more recent period, 0, and we also note that over the next 12 months, indicating great balance sheet, not even 1 day to pay off all of their debt, net of cash on hand. Now our intrinsic value at $38, when we put it through the MOS, at 10% a buy at 35, at 20% a buy at 31, at 30% pretty much around the current trading price. So yes, we see a 30% MOS, but Wall Street, they have very high price targets, $44, 69% upside. The only one thing that we do want to flag here is that we have covered this company a few times, and every time we do, Wall Street continue to lower their forecast, so take it with a pinch of salt. If companies come down, Wall Street, they are essentially more reactive than proactive and will lower their prices. If the company goes up, they will do the same and start to increase. We then take a look at MercadoLibre, which is down around 10% over the last month. Over the last 12 months though, up 30%. Over the last 10 years, phenomenal, outperformed the S&P quite significantly. Right now trading in the mid to upper end of the 52-week range. Double buy signal, hold from Quant, and the forward P looking fairly costly at 56.06. Now over the next 4 quarters, 3 of them they are expecting growth. However, they did miss quite substantially the latest quarter. However, the previous 3 do look very good. Nonetheless, 75% track record, and with the growth anticipated in December 2025, forward P coming down to 40.6. Now their free cash flow per share, probably the best one we have seen so far, 366, rapid rise to 92 in 2023, and in fact nearly expected to double over the next 12 months, so it looks like they are still well and truly in that growth phase. In terms of their sales growth on their numerical basis, double digit every single year, 37 in 23, 35 on a trailing 12 month, looking very attractive as a potential investor. And we can see 560 million reported in 2014, 14.5 billion in 2023. They've also diluted your position, although only marginally over the last 10 years, and ultimately as a shareholder you probably wouldn't care given how strongly that share price has risen and outperformed the S&P during the period. ROIC, unlike the other companies so far, actually positive for the majority, 25% in 2023, 20% on a trailing 12 month, so no complaints there. However, on the operating side, we would like to see a bit of efficiency. We'd like to see margins increase. They've actually decreased over the longer term, and we'd also want a bit of consistency at a minimum around 16%, right now at 15%. Although the positive is to note here, from the lows of 2019, it has gradually increased on a year-on-year basis. And free cash flow margin, whilst very inconsistent, still 1, higher than 5%, or at least that as a minimum every single year, and 2, 32%, 34% on a trailing 12 month, very, very good to note. In terms of the net debt to EBITDA, well look, 0 on the trailing 12 month basis, 0 over the next 12 months. Again, these are growth stocks with absolutely phenomenal balance sheets, net debt to EBITDA for the majority sitting at 0. Now our intrinsic value, 2215, marginally lower than Wall Street, where they see 25% upside, $2,345 price target. And in terms of the MOS today, at a 15% is pretty much where this company sits after the drop that we have noted. 15% MOS for MercadoLibre, 25% upside. Is this one you have been buying recently? Do let us know below. We then move on to Elf Beauty, which has been down 28% over the last 6 months. Over the last 12 months, up only 7%. Over the last 5 years, up 641%. Massive outperformance of the S&P. Trading towards its 52-week lows. Strong buy from Wall Street, a buy from Seek Alpha with a hold from Quant. And the forward PE sitting just below 34. We also love to see this growth expected every single quarter over the next 4. And they've also outperformed over the previous 4, giving that 100% track record. Growth expected into March 2026, lowering the forward P to 28.11. Now, in terms of the free cash flow per share, first thing, positive every single year, bar 2016, and 2024 at 1.14. We are expecting it to more than double over the next 12 months to 256. And sales growth looking very good from the lows in 2020 at 6%, increasing consistently at a very good rate, and a small drop to 59% on the trailing 12 month, which means when we do look at it from that numerical perspective, pretty much increase their top line 5-fold from 2015 to 2024. Similar again to some of these companies today, they have, although marginally from 2017, diluted your position as a shareholder, but as we can see, companies that do that also outperform the S&P with very attractive returns, you probably could say you are more forgiving. ROIC looking good overall, especially over the last 2 years and the trailing 12 month, although at an average we want to see that 10% point, that if you are a more recent shareholder, you would be pleased with those mid-teen figures. Operating margin around the 12% that we want to see for this industry. 15 in 2024 does look good, and the free cash flow margin, we can see quite a lot of inconsistency. Nonetheless, as long as it does hit around the 5% at the bare minimum, we can be satisfied overall. Net debt to EBITDA, the thing I really like about this, it has come down significantly from the highs of 3.99 in 2015, 0.75 in 24, expected to go lower over the next 12 months, and whilst it doesn't sit at 0, still very strong, well below the maximum 3 that we want to see, so all good in fact for Elf Beauty. In terms of the valuation, well, our intrinsic value not that far off Wall Street, where they see 159, 31% upside, and when we put it through the MOS at 10%, a buy at 144, at 20% around 127, and in today's episode, you're getting pretty much a 25% MOS at $120, with Wall Street, as we can see, indicating 31% upside over the next year. And let us know, this is one that we did believe was a very strong buy when it was sitting around the $100 mark or just below. So right now, that is around a 21% gain on the current price. Do give us your thoughts if you believe at the 121 it is still a buy now. We then move on to Airbnb, down 9% over the last 6 months. Over the last year, up 3%. Right now, trading in the mid to low end of the 52-week range. Just one buy rating, that is from Seeking Alpha, hold from Wall Street, hold from Quant, and the forward P sits just above 33. When we take a look at their earnings, well, very mixed, very inconsistent over the next 4 quarters, and unfortunately one of the worst one in terms of management's historical forecasting accuracy. We can see 25% track record, only 1 beat out of the previous 4 quarters. Nonetheless, if you have faith they will hit their December 2025 target, the forward PE will come down to just below 30. In terms of their metrics, well, looking very good. A drop, no surprise, again COVID in the 2020 negative 2.74, but coming up into 2023 610 and expected to have a marginal increase over the next 12 months. In terms of sales growth, well, it does look good, but has been decreasing from the peak of 2021 and even lower on the trailing 12 month at the 13% point. When we zoom out, pretty much quadrupled their top line from 2017. But again, repeating the same thing because it seems to be true for a lot of these growth companies, they have diluted your position as a shareholder over the last few years. ROIC looking good over the last 3, but even before then we can see negative severely in 2020. Nice to report the 15% on a trailing 12 month. And the operating margin, again, a lot of inconsistency is what we are noting here. Free cash flow though from 2021 looking very good, around the 40 to 44% point. And the net debt to EBITDA, again, whilst we do note a lot of inconsistency across these growth companies, they do tend to have very, very good balance sheets, which is ideally what you want, especially if there are times where they do face some difficulties. In terms of the valuation today, $158. When we put it through the MOS, 10%, a buy at 142. At 20%, it isn't quite there yet. So for Airbnb today, we see around a 15% MOS with only 5% upside from Wall Street at $139, the one that did have the least in today's episode. As always, give us your thoughts in the comments below whether any of these are a buy, maybe a hold, or in fact maybe a sell. If you enjoyed today's episode, well, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to sign up to the free weekly newsletter below. We are dropping a new copy to your inbox tomorrow morning. And come and join us in a Patreon where we do run through our buys and sells on a weekly basis. As always, have a great day and we'll see you all on the next one.